The 20-year T-bond crossed 5% this past week and stayed there. Are you crazy to wait for 6% Treasuries? Hello, members, super savers, and bond course fans. I hope you're healthy and well, and welcome back to our weekly update. So, one of the many reasons I love our community here is that you guys and gals are always ahead of the game. The 20-year Treasury bond crossed 5% this past Wednesday morning at 7 a.m. Eastern Time, as you can see here. So even before the market had opened for regular trading, and within the hour, I already had the first message in my inbox from a Diamond NestEgg member asking me if we should buy the 5% or wait for Treasuries to hit 6%. So with that in mind, here are the three topics that we'll be covering in today's update video. 1. Which Treasuries crossed 5% this week and why? And are you crazy to wait for 6%? In this section, I'll also talk a bit about what we ended up doing with some of the cash that we've had parked in T-bills and money market funds up until now. 2. Which Treasuries rose the most and which ones fell this past week? And 3. What's on the upcoming week's Treasury auction schedule? Plus, what are the highest yielding opportunities for new issue agencies, corporates, and brokered CDs right now? As usual, here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks. Which Treasuries crossed 5% this week and why? And are you crazy to wait for 6%? Longer dated Treasury yields have been rising since the end of last year. In the first 7 trading days of this year alone, yields on maturities 2-year and above have increased by double-digit basis points from where they were on December 31st, largely driven by 2 factors. First, concerns related to both the recent stickiness of above-target inflation as well as the potentially inflation-generating economic policies of the incoming administration. And second, the Fed signals that they would likely slow down the pace of rate cuts this year as a result of these concerns. That's what pushed the yield on the 20-year Treasury across 5% here this past Wednesday. But it didn't stay there for too long initially before falling back down to the high 4s. On Friday, though, the BLS released its blowout jobs report for last month. Total non-farm payroll employment increased by 256,000 in December. This was up from 212,000 reported in November and nearly 100,000 more than the market forecast of 155,000. In addition, the unemployment rate at 4.1% came in slightly lower than the 4.2% industry estimate. And taken together, this pushed the yield on the 20-year T-bond above 5% once again. And this time, it stayed there, at least at the time of this taping. Employment numbers like these give the Fed further reason to keep rates stable. In fact, some on the street have even started to speculate that the Fed may raise rates again. According to Reuters, Bank of America is betting on a potential rate hike after the recent jobs report. That's not a bet that I'm willing to take at the moment, but who knows, right? Especially since the crystal ball that Marcus bought me for Christmas doesn't seem to be working all that well. Plus, by the way, the crystal ball was on sale, it seems, meaning I'm having a bit of trouble returning it right now. In any case, the 30-year T-bond also spiked briefly above 5% after the BLS's monster jobs report. But it wasn't able to fully hold on and ended the day a tiny bit below that. So, for those of you who asked me this question, are you crazy to wait for 6% Treasuries? My answer is this. The last time longer dated Treasury yields were above 5% was in October 2023, and I know that quite a few of you have been waiting for another 5% moment. Now is that moment. This is not to say that you should go all in or that Treasuries on the long end won't hit 6% one day. Anything is possible, but that day, if it comes, might be far away. And if you're in retirement or about to retire, those 6% Treasuries may come at a time that no longer fits your timeline. And if you're dollar cost averaging already, Perhaps this 5% moment may be a chance for you to dollar cost average in slightly higher amounts if it suits your situation. Personally, I did actually pick up about $50,000 in 20-year T-bonds on the secondary market on Friday for some of our retirement accounts with the intent of holding to maturity. And if I were in retirement or about to retire, I probably would have picked up a bit more than $50,000. So the way I see it is this. With the yield curve having normalized again, why have money earning less in short-term T-bills and money market funds when I can get a guaranteed 5% plus yield for 20 years? Having this liquidity, safety, and guaranteed rate of return in the form of treasuries as part of our retirement portfolio means that I can play around a bit more with the rest of our cash there and contemplate slightly riskier, higher yielding positions on the equity side of our portfolio. And if rates continue to move up on the fixed income side, well, then I may just pick up even more bonds. But as I always say, that's me, and everyone's financial journey is different. What about you? Are you continuing to dollar cost average as before into longer dated treasuries? Have you ramped up your purchases more as a result of the recent yield spike on the long end? Or are you waiting for yields to go even higher? Drop a comment below and let me and the community know. And for those of you who've asked, our January bond course sale is on so that you can make the most of the higher yields we have at the moment. Use coupon code BONDS2025 to get an additional 10% off of our popular bond course bundle before the end of January. The 10% coupon code BONDS2025 can also be used to purchase Bond Beginners or our intermediate level course Bond Masters individually. As a reminder, our next Bond Beginners live course session will be on Sunday, January 19th at 5 p.m. Eastern Time, 2 p.m. Pacific Time. We'll be diving deeper into this month's 20-year T-bond and 10-year TIPS auctions. So, with that in mind, let's move on now to the next section of today's video. Which treasuries rose the most and which ones fell this past week? As we so often do at the end of the week, let's grab our rates from the Treasury's Daily Treasury par yield curve rates page and compare treasury yields from this past Friday versus the previous week. Here we have all the maturities of the treasury issues at auction. Here's where yields stood this past Friday, and here's where yields stood at the end of the previous week. And here's the increase or decrease in rates over the past week. Increases in rates are shown in black, and decreases in rates are shown in red. Treasuries across nearly all maturities ended the week higher than the previous week, with everything 2-year and longer up by double-digit basis points, driven by all the factors that we've already discussed earlier: the blowout jobs report, inflation worries, and a likely slower path for Fed rate cuts in 2025. Here's our above 5% yield on the 20-year T-bond, by the way. The 2-month was unchanged, and the 1-month was down slightly at 2 basis points. Now, at this point, we typically compare Treasury yields from this past Friday to the beginning of the year. But since it is still the beginning of the year, we'll do things with a slight twist for January. Let's take a look at Treasury yields from this past Friday versus the same day 1 year ago. Again, this row shows where rates ended this past Friday. This row shows where rates were on January 10th, 2024. And this row shows the increase or decrease in rates over the past year. Increases in rates are shown in black, and decreases in rates are shown in red, as before. Treasury yields across all maturities 2-year and up are noticeably higher than where they were a year ago, with the biggest differences to be seen on the very long end, with the 7-year, 10-year, 20-year, and 30-year. Whereas yields 1 year and under are lower than where they were a year ago, with the biggest differences to be seen on the 1 to 6 month T-bills, which is to be expected given that the Fed lowered rates on the short end several times last year. As I've noted previously, one thing that catches the eye is that the yield curve that had been negative or inverted for so long has turned positive, which means that you will finally get a higher interest rate again for lending out your money for longer, as it should be. As of January 10th, 2025, at the extreme end, the difference between the 1 month versus the 30-year now stands at a positive 54 basis points versus 38 basis points a week ago, and a negative 133 basis points 12 months ago when the yield curve was still inverted. And the widely used comparison of the 2-year versus the 10-year Treasury now stands at a positive 37 basis points versus 32 basis points a week ago and a negative 33 basis points 12 months ago. You can find more details on these rates for any day of the week that the bond market is open on the Treasury's daily Treasury par yield curve rates page, as I mentioned earlier. All sources are linked below in the first pinned comment. Do keep in mind that this overview gives you a general feeling for where rates currently stand along the maturity spectrum. The yields that you may get when you buy at a specific auction or from a specific broker, or when you sell, will likely differ a little bit from what's shown here. Now that we've covered Treasury yields from this past week, let's move on to the next section of this video, especially for those of you who are interested in agencies, corporates, and brokered CDs as well. What's on the upcoming week's Treasury auction schedule? Plus, what are the highest yielding opportunities for new issue agencies, corporates, and brokered CDs right now? Here we are at Treasury Direct's upcoming auctions page. If we scroll down, we can see that all the weekly T-bill and CMB auctions are happening as usual. Other than that, it's pretty quiet on the Treasury auction front. So, that was Treasuries for this week. For those of you who may be interested in other types of bonds and CDs for a bit of a higher yield potentially, here's where the highest yielding new issue agency bonds stand at the time of this taping, with the highest yielding one from Federal Home Loan Banks at 6.3%, with a first call date in April 2025. Here's the CUSIP for those of you who may be interested. For corporate bonds, the list is fairly long this week on Fidelity. Here's where the highest yielding new issues stand at the moment, with the highest yielding one from Deutsche Bank at 6.05%, with a first call date in January 2026. Here's a CUSIP for those of you who may be interested. If you want more details on the top new issue agency and corporate bonds we found this week, then check out this recent video where we walk through all the CUSIPs that we thought would be of most interest to our Diamond NestEgg regulars. For brokered CDs, the highest yielding one is from Regions Bank at 4.6%, with a first call date in July 2025. If you know of any bank CDs or high-yield savings accounts with particularly attractive rates at the moment, please do drop them below and let me and the community know. All right, members, super savers, and bond course fans, I hope you enjoyed this video and learned something new. And as always, if you want to really get up to speed on bond investing and building out your bond portfolio so you can grab some of those 5% treasury rates before they're gone, then check out this video here on our bond courses, which we are in the process of updating. Don't forget to use coupon code BONDS2025 to get an additional 10% off of our popular bond course bundle before the end of January. The 10% coupon code BONDS2025 can also be used to purchase Bond Beginners or our intermediate level bond course, Bond Masters, individually. And as a last reminder, our next Bond Beginners live course session will be on Sunday, January 19th at 5 p.m. Eastern Time, 2 p.m. Pacific Time. We'll be diving deeper into this month's 20-year T-bond and 10-year TIPS auctions. And our next YouTube member live will be on Sunday, January 26th at 5 p.m. Eastern Time, 2 p.m. Pacific Time. We'll be diving deeper into this month's upcoming 2, 5, and 7-year Treasury auctions and all things fixed income. I've also linked all the details on our bond courses and YouTube Super Saver membership below this video for your convenience. Good luck to everyone who's planning on picking up some bonds and or CDs this coming week. And see you again very soon with more brand new wealth building content for your financial journey.